What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest in this week's episode is Robin Wigglesworth, the Financial Times global finance correspondent and author of a new book titled Trillions, which chronicles the origins, history, and future of the index fund, arguably the most disruptive financial innovation of the last 50 years. We spent the entire first half of our conversation on the book itself, exploring the history of passive investing and its evolution into what some argue has become a market-distorting phenomenon that is making markets less efficient by inhibiting price discovery and concentrating power in the hands of an increasingly smaller number of index fund managers and purveyors of indices. In the overtime, we switch gears to discuss some of the timelier stories concerning investors, including inflation, whether or not it's transitory, and what central banks are able and prepared to do in order to curb it. Robin and I also discuss the ongoing trading scandals of the Federal Reserve and what they say about the extent of corruption in government, the loss of faith in public institutions on the part of investors, and how that loss of faith is reflected in the casinofication of markets and the speculative manias we've seen in meme stocks and cryptocurrencies. It's a phenomenal hour-long overtime that you will not want to miss. If you enjoy the free content that we produce every week, I encourage you to take the leap and become a premium subscriber if you haven't already. There's no commitment, you can cancel at any time, and the entire library of subscriber content going all the way back to episode 1 becomes instantly available to you, including the overtimes, afterthoughts, transcripts, and rundowns, depending on your tier. So without any further ado, please enjoy this week's episode with my guest, Robin Wigglesworth. Robin Wigglesworth, welcome to Hidden Forces.
No, thanks for having me.
I'm effectively having a conversation with a microphone because it's covering up your entire face. So,
Yes.
Robin, again, welcome to the podcast. It's great having you on. You've written a really phenomenal book that we're going to discuss today. Before we do that, though, I'd love to hear a little bit about your background, because I've heard you say that you were an aspiring physicist, though I think you said perhaps a mediocre one, who settled for journalism. And I'm curious how that happened. Like, how does that work exactly?
Well, I was good at mathematics and sciences at school for a long time, and I always wanted to be an aeronautical engineer or a physicist. But I think it was the last couple of years of high school I realized that I only had the mental acuity to be a mediocre physicist. I'd probably end up being a high school teacher. And that didn't really sound that fun. So I decided to do something else. And journalism was something I just drifted into without really having any idea of what it was like or whether it'd be any fun. And luckily, it turned out to be a lot of fun. So I basically stuck to it.
So it was journalism that interested you, not initially finance and markets? Like, was that the entry point?
It's a good question, because a lot of journalists come at this in different ways, enter into the industry in different ways. I think it's changed a lot. I mean, I certainly was of a generation where I grew up with, a little bit of Cold War back home, seeing, the Iraq invasion, the first one, Desert Storm. It's exciting seeing CNN in Baghdad. So I always wanted to be a foreign correspondent. So I studied international relations and Middle East studies. Ended up in financial journalism by chance. It was the only thing that, offered decent salaries and had plenty of jobs in the mid-2000s. And I just fell in love with it from day one. I mean, it's you talk to really interesting people. You learn how the world really functions, maybe a little bit better than in many other areas of journalism. And it's just fantastic, complex, and interesting. So every day is new and different, and every day is generally better than the last. So what's not to love?
Yeah. Well, it's interesting you say that. I mean, I came from the same point of view. Does that mean that you've always had a greater interest in the macro picture? Not just because of your studies, but in fact, because your studies reflect an inherent interest in those forces?
To a certain extent. I mean, certainly macro is something that has always interested me. Even when I was studying, politics and international relations, I had a very sort of facile understanding of how important economics was to the world. Mm-hmm. So I was interested in that side. But my first job was actually covering Islamic finance in the Middle East, which was of a nice synergy between, a new field and, the Middle East that I'd studied for a while. And then from then I drifted from financial journalism, sort of covering banks primarily, to covering macroeconomics in Scandinavia. I'm originally from Oslo, Norway. And then from there, I actually joined the FT as a Middle East correspondent again. And then again, kind of bounced back into markets and have stayed there ever since. And, it's never disappointed me.
Yeah, interesting how the Middle East has taken a back seat from where it was in the early 2000s post 9/11. So I mentioned at the very top that you've written a phenomenal new book. The book is titled Trillions. How would you describe the book when speaking to people who haven't read it?
Well, I've tried to write an actually interesting book in that, I'm somebody who's scarred from having read lots of quite boring, staid, jargon-filled books, which, I still find fascinating, but they aren't as enjoyable to read. And for me, this is genuinely one of the biggest trends, one of the biggest phenomenon in financial markets, in finance more broadly. And the more I started scratching into the backstory of index funds, of passive investing, the more delightful the story became. There were really interesting people that did this. You kind of forget this, that, somebody invented the television or the phone or the internal combustion engine, and somebody invented index funds. And the story of how they did that, I thought was fascinating and needed to be told. And then I wanted to use that narrative as a prism to look at how it's developing today. So people don't just learn a bit of history about how investing has evolved over the past century, really, but also how it's literally affecting their lives today and will in the next decade or two.
That's such an interesting analogy. So do you view index funds in terms similar to those of disruptive technologies? I mean, is the index fund, the construction of index funds, a type of technology?
Exactly. That's how I see it. And I think that's a good framework to look at it, because it explains quite a lot of things. Everything from where it was invented. It was not invented by mainstream organizations, Wall Street. It was invented by some sort of crazy renegades working at, frankly, third and fourth tier financial institutions far away from New York or London. And they were widely hated by the industry they disrupted. But eventually they were proven right. And the inherent benefits of this became clearer to more and more people. It just exploded. And we are now at the point where we start worrying about the negative externalities of that technological disruption. So I think it has parallels with a lot of other inventions in many other parts of the economy.
So where does this story begin? Because you don't just cover the 1970s period with the invention of index funds. You actually go further back to explore the foundations of the ideas that buttress these innovations. So where do you begin the story here?
Well, I think, it's a cliche at this point, but to understand where we're going, you need to understand where we're coming from. And I want to tell the full story of the index fund, the intellectual backdrop as well. So, the first pooled investment vehicles were invented in the Netherlands and the UK several centuries ago. But I start my story with Louis Becquelier, who was a French mathematician around the turn of the century. He did his PhD at the Sorbonne in 1900, and he died in obscurity. He was a nobody, essentially. But his PhD thesis, called The Theory of Speculation, was later discovered almost by chance by some very well-connected and famous American economists, primarily Paul Samuelson, the first American Nobel laureate in economics, and he popularized it. And that's kind of where a lot of intellectual ideas and work sprung out of. So what we know as today is the random walk or efficient markets theories, they started with Louis Becquelier's work in Paris over a century ago.
So what was his theory of speculation? What did he posit in his paper? And for those who don't know, what is the random walk hypothesis? What does that refer to?
Well, so Louis Berkeley had a really interesting life. He worked for his father when he was very young, who ran this vintnery in France, but he was pretty good at the sciences. So he was supposed to go to study mathematics at the Sorbonne when he was 18, 19, but then his parents died shortly before. Into quick successions, he had to take over the family business at 18 and take care of his sisters. And then when he was finally sort of got the business back on solid footing, he was then supposed to go to the Sorbonne again, and then he got drafted in the French army. And he only belatedly managed to make it in the Sorbonne at a slightly older age. I think he was around 30. But he didn't have the family wealth that, frankly, all his other contemporaries had. So he had to get a part-time job at the Paris Stock Exchange. And look, this is, at a time when, finance was grubby. This was not a cool area to work for a century ago. And it certainly was not cool in France, and arguably probably isn't today. So he had to work, and that made him a little bit different. But he decided to use what he'd seen at the Paris Stock Exchange to inform his PhD thesis. So he wrote basically a mathematical exposition that looked at how stocks moved and how you could calculate it, and describing that motion as essentially what we now call Brownian motion. So they move basically randomly, like a drunk person stumbling around in the dark at random. And he also pointed out that, at any given time, somebody's buying a stock, somebody's selling it as well. And presumably, these people, you have to assume, are roughly equally informed overall for the market as a whole. So the seller thinks he's getting a good deal, and the buyer might think she gets a good deal. So at any given time, the market, though he didn't use this word, is probably roughly fairly valued according to the information people have. Now, he actually got a decent grade for this PhD thesis, but only because it was finance. His teachers, his PhD tutor was a famous mathematician called Henri Poincaré, gave him a sort of a good but not great grade because, it's a really cool original thesis, but, it's finance. That's a bit weird. We're French mathematicians. And because of that, he basically never got tenure until another 20 years later, and he died in obscurity. But, he actually calculated how stocks moved randomly, before Einstein did something similar in physics. And it was only later that economists discovered his work and realized how revolutionary it was.
Was he able to understand why markets were unpredictable? In other words, why he was able to see patterns, consistent patterns, but that those patterns didn't actually yield meaningful information about the future that was predictive?
Essentially, he shied away from that. I mean, nobody really knows what else he kind of worked on. He worked on a lot of probability mathematics. It was one of his specialities. But there's very little else that survived of his work, underscoring how obscure he was in his own time. Nobody really thought this was revolutionary or interesting that much. Some mathematicians translated his work and thought it was interesting. But he didn't dive into the implications. He was not a finance person, really. He just happened to write about the stock prices because he worked at the Parisian Stock Exchange at the time. And it was only later on that people realized the implications of this. He essentially just came up with mathematical calculations showing how you can calculate or show stochastic movement. And also the realization that probably every buyer and a seller, if they're equally informed, shows that the price is roughly fair.
The beginning of efficient markets. Or the hypothesis around efficient markets. So how much later did his work get picked up again? And when and how do folks like Harry Markowitz, William Sharpe, Eugene Fama, et cetera, factor into this picture?
Well, so I always think of it as two strands. There's both the realization that the average professional fund manager does badly or cannot beat the market on average. And over time, the skew is such that actually the vast majority underperform. And then the broader theory of why that is. So they work in parallel, but sometimes they can be sort of distinct from each other. Berkeley's work was primarily spread across the United States among economists by it's a very famous statistician called Jimmy Savage at the time in the 50s. He happened to discover a translated PhD thesis of Berkeley in his university library, who's just rummaging around at random. And he was best buddies with Paul Samuelson, who had immense reach at the time. And Paul Samuelson was a guy that spread a lot of the knowledge about. At the same time, another famous French mathematician called Benoit Mandelbrot who'd escaped Europe. He started teaching Europe, among other places, in Chicago. And he was very familiar with Bekeley's work. And he taught a young grad student called Eugene Farmer at Chicago in the 60s. So you can start seeing how these ideas start spreading around. And this is pre-internet days. So things were slow. It took years for papers to first of all be published, but then also, people actually read them and mailed around. Markowitz enters the frame, in the 50s when he was studying economics at Chicago, knew absolutely nothing about finance and markets, but somebody suggested to him that he should write about markets. Essentially, a visiting stockbroker struck up an entirely random conversation with him and said, "Oh, young man, you should do something about the stock market." And Markowitz talked to his tutor, who said, "Yeah, that cool idea, bro. Go for it." And he did. And almost randomly, he came up with basically the idea that you obviously have to trade off risk versus reward, which makes intuitive sense. But his big leap was using volatility as a proxy for risk, and therefore mathematically showing that actually you can, with enough diversification, you get the optimal trade-off between risk and reward. So, and if you add more stuff into a broader portfolio, the more diversified that portfolio is, the more you lower the risk, and you can increase the risk, the reward to risk, essentially.
This has become conventional wisdom for the last several decades, but it's very difficult to overstate how radical this line of thinking was in the 1950s. I mean, in that period of time, the idea was much more along the lines of a Carnegie, put all your eggs in one basket and watch the basket. Understand what you're invested in as well as possible. Become an expert in whatever it is that you're investing in. That's the way to make money. But Markowitz was saying the exact opposite.
Exactly. It was radical at the time. I mean, some people intuitively understood that, you don't put all your eggs in a basket and had some rules of thumb. But broadly speaking, this was not a quantitative field, investing at that time at all. And this was ivory cow. He almost didn't get a PhD in economics because Milton Friedman thought, it was an interesting mathematical theory, essentially, but you couldn't calculate it. There weren't computers around that could calculate it. The only people that had computers that could do Markowitz's calculations were in the hands of the US government, and were used to design nuclear weapons. And because it was more maths than economics, Friedman almost denied him a PhD as well. But he won the Nobel Prize for it eventually.
Right, and it was very formulaic. And it was sort of like, there is a formulaic approach to investing, but that formulaic approach is that, on average, investors are average. The best you can do almost all the time is to just invest with the broader market. And the challenge is, how do you construct the most representative market portfolio possible? That's the other interesting thing. At the time, computational power didn't exist, or at least the computation was effectively the power of the human brain. And to the extent that you could get access to computing power, it was limited. How did that factor into the construction of beta? And what is beta also? Because that's something that people hear often about, but they don't actually understand the intellectual origins of it.
So that was actually, a young grad student who worked with Harry Markowitz called William Sharp that sort of almost inadvertently coined as an issue. So Bill Sharp was going to be a doctor, but he hated the sight of blood. So he decided, well, I can't become a doctor then. That's just silly. So he ended up in economics, loved it, and happened to work with Harry Markowitz at Rand whilst Bill Sharp was also doing work for his PhD. And essentially, Bill Sharp's big thing was, first of all, for his PhD thesis, he essentially simplified Harry Markowitz's calculations, his equations. So Markowitz's equations were so complicated because you had to calculate basically the covariance or the correlation with each individual security with each other. So for an entire stock market, that would be completely impossible. But Sharp basically stipulated, well, let's just assume the correlation between an individual security and the market as a whole. And the market as a whole was given the word beta. And that's how beta entered the lingua franca of finance. And later on, Bill Sharp was the guy that came up with what, was the Sharp ratio, which was, measuring how well a fund manager does by comparing the volatility of the returns versus the total returns, so Sharp ratio. And also something called the capital asset pricing model, which is still, widely used, even though it's, has all sorts of hair on it. But he also showed that overall, and he never used the term necessarily beta as in the sense of an index fund, and never talked about index fund, but he talked about the market portfolio being the optimal trade-off versus risk and reward. Now, he meant everything, right? Not just the S&P 500, but essentially he was the first guy that articulated that as a theory.
So would you say this is also the origins of thinking about risk in terms of volatility?
Yes, definitely. This is how we start seeing, this is the birth of value at risk, for example. That risk being volatility this is how it entered the bloodstream of finance. And it never
It's
left.
fascinating to think about how oftentimes reality derives from, to what extent reality derives from a set of theories that we construct in order to understand it. And then we begin to put ideas into practice and shape the world according to those theories that we develop. And what we see in this period is that development of the intellectual foundations of those ideas. When did we begin to see those come into practice? And how did those practitioners come to understand those ideas? Because these were still niche ideas. It wasn't like they were in the popular mind.
Yeah. I mean, people had started to do some ad hoc studies that show, fund managers maybe do a poor job. Alfred Cowles famously did one in the 30s after the Great Depression. But, they were of poor standard and not comprehensive. You couldn't really do this until the invention of the computer. So it was in the 60s. Merrill Lynch basically paid the University of Chicago to do a mammoth data project. I mean, this was absolutely gargantuan at the time. It took 4 years and cost tens of thousands of dollars at a time when that was real money to calculate the overall return of the stock market in the long run. Because weirdly enough, as it sounds to us today, people didn't know what the long-term return of US stocks was. But under Jim Lowry, another colleague of Gene Farm and the others, he showed that the US stock market had, really great long-term returns, but also those long-term returns were greater than the average returns of professional money managers. Now, again, it took a long time for people to cotton onto this, certainly the ordinary people and quite a lot of pension plans. But the University of Chicago and led by Merrill Lynch that financed this study started spreading it around the industry in the 60s. And that's when you can start seeing a lot of this research, all this academic ferment really entering the world of practical realities. And it is in the 60s as well that Wells Fargo hires a young, stubborn, former Navy destroyer engineer who worked at Solomon Smith Barney at the time to think up ways where they could use computers to improve outcomes in the financial industry. This was pretty radical at the time, but that guy, John McMcquown, he's the guy that invented the very first index fund.
And what year was that?
So he was hired by Wells Fargo in 1964, but the index fund didn't actually happen. The first variant of it didn't happen until 1971.
So what was the reaction at the time to the invention of the index fund? What did people think of the idea of investing with the market average?
Well, most people hated it or were oblivious to it or mocked it. Certainly in the industry, the reaction was largely a mix of heavy shrugging, laughter, or anger.
Did they view it as lazy also, as something that was antithetical and un-American?
Yeah, essentially. So there was a very famous poster, that wasn't until the mid-80s, I think, that showed the famous Uncle Sam of World War II posters, basically with a big stamp saying, "Stamp out index funds, they're un-American." And quite a lot of the early pioneers of indexing ended up with that poster on their walls in their offices. So they kind of took that as a point of pride. But initially, people just thought this was a curiosity. So Mac McCrown had assembled, one of the biggest economic think tanks in history at the time. So basically, he'd been given carte blanche by Wells Fargo to hire anybody he wanted, pay whatever it needed to do cool shit, essentially. And, at various times, you had Gene Farmer, Bill Sharp, Harry Markowitz, Jack Traynor, Myron Schultz, Fisher Black, basically an all-star cast of economists of the 60s, 70s, and 80s working there. The 6 of them went on to win Nobel Prizes in economics. So it was pretty high-powered stuff. But even so, the finance industry broadly thought this was a nothing burger. Who wants to be mediocre? It's in our nature. It's certainly in Americans, right? As Johnson, the patriarch of Fidelity, once famously said, nobody wants to be operated on by a mediocre surgeon. The name of the game is to be the best. So this was just seen as not just lazy, but just giving up, essentially. But lots of pension funds who had a lot of fund managers and had the data internally, most famously AT&T. At that time, it'd been kind of atomized into lots of different bells. So regional bells, and each had their own pension plan, but they shared information. And the bells were the biggest investors in the American stock market. They saw the data. They realized they were essentially paying hundreds of fund managers to swap stocks between them, costing lots of money in active management fees and trading costs. So the Bell system became the vital spark that funded Wells Fargo and the other handful of early index funds in the early 70s.
Yeah, it's also important to note that Wells Fargo was not the Wells Fargo of today. It was a small institution. No. So to your point about innovation, these were the scrappy players. These were the underdogs. How much of this was also about taking advantage of asymmetric opportunities, playing to one's strengths, or in the case of Jack Bogle, playing the hands that you've been dealt? And Jack's actually a perfect example of this because he wasn't a predisposed advocate of passive, but indexing offered him an opportunity to redeem himself after having been sacked at Wellington. So how much did that factor into the equation?
No, it's a great point. I mean, Jack Bogle essentially embraced indexing, but he hadn't always done so. You know, he was somebody who believed with every fiber of his being in one thing, but what that one thing was could change over time depending on circumstances. And yeah, so the first pioneers, as I see them, was Mac McCown at Wells Fargo, which, as you say, was a tiny regional bank then. It was not the Wells Fargo of today. Rex Sinkfield at American National Bank of Chicago, which was, not even the biggest bank in Chicago at the time, with a fairly mediocre small trust department. And Dean LeBaron at Battery March, who was this super eclectic, gregarious, outgoing, zany guy who worked at a small firm that he'd set up himself in Boston.
This is also, just to be clear, also very American focused, because you don't cover any of this. Like, you didn't discuss Jeremy Grantham, for example, or anything that was going on outside of the United States?
No, so at the time, there was very little indexing in a formal way happening. Now, the dirty secret of the investment industry is that a lot of people have, for a long time, been doing indexing, just doing it without telling their clients that they're charging 1-2% a year to basically buy the entire market. And they trade a little bit here and there to show that they're doing some actively. But these sort of closet indexes, as they're called. But nobody had actually started an index fund internationally until the 70s, at least as far as I'm concerned. There have been some de facto index funds in the UK and the Netherlands. For example, the very first collective index investment trust in the world was essentially literally bought some physical bonds when it was written on goat skin and paper and locked them up in a safe for 50 years. So that's kind of an index fund, but there weren't any even indices around that time. And Jack Bogle only entered the story later on by chance, as you say.
So let's talk about Jack Bogle's story because it is fascinating. How did Jack come into this picture?
So he was the wonder boy of the investment industry. See, he was, somebody had come from money in Philadelphia, old money in Philadelphia, but essentially his father lost all the money in the Great Depression and then basically drank up the rest, became an alcoholic. So, I think Jack felt that fall quite acutely, him and his brothers. And so he's essentially had a bit of a chip on his shoulder from an early age and just worked harder than everybody else. So he put his way through Princeton, wrote a thesis there, at the time, very nascent mutual fund industry in America that caught the attention of Walter Morgan, who was the founder of Wellington. At the time, one of the biggest mutual fund groups in America, but also one of the few ones. There were only 20, 30 of them at the time. And he was hired. And he did an amazing career at Wellington. He was the wonder boy, the heir apparent eventually, and also not always appreciated. He also wrote, under a pseudonym, a scathing article ridiculing the idea of index funds before they were even born. So somebody suggested the idea of a market portfolio almost casually. And he wrote in a financial journal an article saying this is preposterous because everybody knows that big major mutual funds always outperform the market, essentially.
Making the case for active management in the way we think of it today.
Essentially.
Yeah.
So he was under John B. Armstrong, I think was the pseudonym he used. And then he, essentially took over the Wellington, was top of the world, but this was the 60s. And this was the go-go era. This is the kind of the first dot-com bubble. But it wasn't Microsoft or Oracle or Cisco then, or, today, Tesla or Amazon. It was all about Xerox and IBM were the hot stocks in the 60s. And Wellington was really conservative and boring and fell out of favor. So Jack Bogle merged Wellington with a hotshot young growth managing partnership in Boston. And then when the go-go era ended and everything collapsed in the 70s bear market, his old partners ganged up on him and essentially sacked him as CEO of Wellington. And as a Hail Mary, he managed to convince the boards of the Wellington funds, because they had independent boards, to give him a independent company owned by the fund themselves that would do all their administrative work. And he named it rather grandiosely Vanguard, and decided that he wouldn't be happy with keeping it just as a clerking job. He wanted to do more, and that's why he decided on the index fund.
How soon was he thinking about that? In other words, was that in his mind when he thought about moving over to that division, to overseeing administrative work, and then spinning it as a sort of play on passive management?
Not at all, actually. So in his defense, he had always been a fan of low costs. He'd always talked about that, and he had for quite a few years felt that investment groups serve two masters, and that they're supposed to both generate gains for their investors, their clients, but also generate profits for their owners. And those goals quite often are not aligned. So he was always concerned about this, but indexing, as far as I can tell, never entered his mind until he'd been sacked by Wellington, when he was looking for something to do and read a Paul Samuelson article talking about how indexing had started for pension plans, a few pension plans, but why couldn't somebody do this for ordinary Americans? And Jack Bogle realized that this was the opening he needed, because he was banned from doing investment management in the separation agreement with Wellington. But his argument to the board was that an index fund was not managed. It was unmanaged, so they could do it. And he wouldn't even need to distribute it. He'd just basically get a group of banks to underwrite it, and they do the initial distribution. After that, it would be sold through the existing Wellington distribution. And amazingly, the board bought this argument, and they did their first index fund. But it was purely a corporate power grab, essentially a way to stick two fingers up at his former partners at Wellington to try and get away from under their thumb, essentially.
So what did that first index fund at Vanguard look like, and how has the industry evolved since then? I mean, paint a picture for our listeners around really the growth in this sector.
Well, it's kind of fun looking at the growth today and think about the start of the Vanguard 500 fund, as it's called now. The first index investment trust was just an abysmal failure, just a colossal disaster. It was famously named Bogle's Folly by the financial press at the time, because Bogle had hoped it would raise $300 million at the time. Quite a lot. And everybody thought that was a bit too optimistic. And I actually saw like the bets that people at Vanguard put on how much they'd raise. I think the lowest bet was something like $30 million. But in reality, it raised $11 million. It was just an abject failure. That was so little, it couldn't even buy all the stocks in the S&P 500. It took years. They had to sample for the first few years. And it grew really slowly. It only managed to cross $100 million because they merged it with a larger fund that was basically going nowhere. It wasn't really until the 90s things started to take off. But then things really started to take off. And since then, essentially, it's been a story of investors looking for cheap products, broadly speaking. Both active and passive cheapness is generally won through. And sometimes falling in love with a hot fund manager or certain sectors or certain styles in certain markets, like growth managers and the dot-com bubble. But every single bear market has actually just accelerated the shift into passive investing rather than slowed it. This is one thing you keep hearing, right? Come the next downturn, passive will lose out. Active managers will prove their worth. But in fact, it's the opposite every single time.
How much of that allocation was actually, there's a great quote that I've got from you here. I don't remember where it was that I heard you say it, or I don't actually have it. I have it in my head, which was something along the lines of, the road to passive has been paved on the backs of basically failed active managers. How much of that allocation that happened every bear market cycle was simply a function of the fact that active managers consistently underperformed the benchmark?
A lot of it. I mean, some of this data just started becoming better known.
Interesting. So it wasn't just that. It was also the fact that the data was more widely available. People were able actually to see performance and measure it against the broader market.
Yeah. So for the institutional investors, now there really have been two stories here. On the institutional side, most big institutional investors will still invest with active managers, but certainly when it comes to like a core equity allocation to, let's say, European or US stocks, it started shifting towards passive in the 80s and 90s. Retail was way slower, way slower. And that's only really sort of 90s, but 2000s onwards. So, I think it took something like 2 or 3 decades for passive to hit the first trillion. Mm-hmm. And now it's taking in $1 trillion a year, or it's growing by over $1 trillion a year. Like part of that is it just flows, going from active to passive because of the cheaper costs and the performance, de facto long-term performance advantage. And some of it's just obviously the markets have been really buoyant in the post-crisis era. But now it is roughly $1 trillion a year. That is, the passive side is growing. Whilst active is lagging.
And the consequences of that growth, of the not just the growth, but the dynamics, the self-reinforcing dynamics that exist in indexing and the economies of scale that motivate that kind of growth and concentration is something I want to ask you about. Before we do that, I'm curious how the invention and growth of index investing influenced the creation of new indices and also the development of the ETF.
It's a great question because I think the role of the index is the sort of underappreciated part of the passive investing revolution. So indices were not sexy businesses. They weren't really businesses at all. They were typically started as a service by people like Charles Dow, who founded the Wall Street Journal, so the Dow Jones Industrial Average, or the Financial Times, my employer, the FTSE indices. They were not considered core businesses. They were not considered profit centers at all. But then with the growth, both of active managers that investors wanted to benchmark against something, so they needed to license an index, a recognized, respected index, and especially more recently, the rise of passive and also the derivatives industry that, anybody who has a S&P 500 future has to pay a certain royalty to S&P for that. It's become just a massive business with profit margins that, would make a newspaper owner weep with joy. I mean, these are, in many cases, more profitable than the biggest technology companies of the world. Index providers have thicker profit margins than an Apple or a Google.
Is that because their costs are so low?
Essentially, you don't need that many people to run an index. I mean, you need a certain amount, but it's not labor intensive, right? And once it's up and running, there's a fair bit of just maintenance that has to be done. But once you have a certain amount of AUM and fee revenue coming into this, it's just clean profit. Essentially, index providers are almost like one of the original subscriptions as a service business models. That you start an index, you get it to a certain size when it's just a cost, and at some point, it just pays for itself and just starts throwing off money like confetti. And that obviously tempts people to then just create new indices because there's a first mover advantage. Not always. The Dow Jones Industrial Average is widely cited, but as an actual financial index, it's close to useless. It's a historical anomaly for all sorts of technical reasons, whereas the S&P 500 is just a better index. But broadly speaking, first mover advantage is huge. So the index providers, once they became a proper, serious industry, just started chucking products out there for people potentially to track.
So I'm curious, first of all, how many indices are there? And how many indices are there relative to index funds? And then also, to what degree does an index, in other words, if an index fund is targeting a particular index that isn't necessarily a broad measure of the market, to what degree have we strayed? And this is also true, of course, for ETFs. To what degree do we actually stray from the original purpose of the index fund to something that's basically effectively active management?
I agree. And this is, I think, one of the core issues that the passive investing boom is going to face and is facing already. So roughly speaking, there are around 3 million indices being maintained by the major index providers. Now, that sounds like a lot, given that there are only sort of 100,000 stocks around the world. But of course, those indices also include bond indices. They include different indices of different currencies, different screens, some that might be Sharia compliant, some that are Catholicism compliant. So you can do anything in any different way. So a lot of people focus on the indexing supernovas of example A of why the indexing revolution has gone bananas. But in reality, like, there are more books than there are letters in the alphabet. You can chop and change them in any way you want. So that's fine per se. But yes, that there is increasing product proliferation that is essentially taking the always blurry line between active and passive management, which has always been somewhat arbitrary anyway, and just basically blown it to smithereens, is a real issue. I do not see a meaningful difference between putting a hot tip, basically betting on a hot biotech stock or a hot biotech ETF, essentially. So we are basically inventing new, kind of newfangled ways to make the same dumb mistakes that we have made through history that gave birth to the index fund 50 years ago, essentially.
So is that also another way of saying that, I guess here's what I'm trying to get at. There were two components to Bogle's decision to go all in on indexing. One was the observation of Markowitz and Sharpe and those guys, which was effectively around the market average and the challenge of beating the average. And then the other one was the cost side of the equation, right? Something that, again, you highlighted with Bogle. What we seem to have with, say, ETFs or these index funds that target all these different indices is that they continue to give you cost advantages, but they allow you to begin to actively manage portfolios in a way that's inconsistent with that sort of intellectual foundation. Does that make sense? I mean, is that sort of what we've seen? We've taken the cost advantages, but we've strayed away from the intellectual understandings that buttress the index fund to begin with.
No, that's a great summation of it. And it's not even just the cost that we haven't kept that. Essentially, I mean, if we dive into the ETF side, I mean, people think of ETFs as passive products because that was their genesis. You know, the first ETF, the first major ETF was SPDR. It was invented by the Amex and State Street to be basically track the S&P 500. So people always think of ETFs as purely passive, and it is the vast majority of AUM, the assets under management, are in sort of big, cheap, boring, plain vanilla ETFs, essentially. But the ETF is way more flexible. And it is allowing people to do all sorts of different things that was hard in a traditional mutual fund structure. So whether it's fixed income or derivatives or more blended strategies, there are all sorts of things that you can do with an ETF. But we have seen throughout history that we humans are great at financial innovation, but eventually we overdo it. You know, think of securitization. Securitization is a legitimately awesome invention that has actually made the world a better place. But we went completely off the rails in the noughties, right? We did all sorts of dumb stuff with it. And essentially that is what, I'm not sure we're there with ETFs and index funds, but we're kind of approaching that point where there are so many ETFs that do so many different things. There are so many providers that are just chucking stuff against the wall and seeing what sticks, that yes, people are forgetting that the original wisdom, the kernel, the genesis of index funds and passive investing was that actually this is really hard, certainly for individuals, but even for the smartest professionals in the world, this is hard. And most people will be better off just getting a broad, cheap, diversified product. Because Jack Bogle, as you say, Jack Bogle was not actually passive jihadist, as I call it. He believed in active management. He was great friends with Steve Neff, you know, John Neff, who was like a famous fund manager at Wellington. He still thought some people could do it, but he thought that most fund managers weren't good enough to overcome the costs. So he thought cost was important. Mm-hmm. He always said it. He didn't believe in the efficient markets hypothesis, but he believed in the cost matters hypothesis.
Right.
And I think that's what people are forgetting, because a lot of these new ETFs are pretty pricey as well.
Mm-hmm. So, Robin, I'm going to move the rest of our conversation into the overtime. What I want to focus there is obviously one big personality we've left out of this first half of the conversation, and that is Larry Fink. And given that we're talking about ETFs, he's really the perfect person to talk about when we get to the overtime. But I also want to talk about the larger concerns around the rise of indexing, the rise of passive. And some of those we've discussed with folks like Mike Green, who you quote in the book.
Yeah.
But there are other concerns as well, most notably ESG and some of the stuff around the power that these providers like BlackRock have increasingly. I mean, I think BlackRock owns, roughly 5% of every major listed company. They have the ability to influence the boards, decision-making at these companies. And also these companies themselves are influenced even passively, so to speak, by what they think these managers and index purveyors expect and want to see. And that influences their own decisions preemptively at their own companies because they're sensitive to how those decisions might impact the manager's decisions around index construction, fund creation and management, etc. I also want to ask you about some of the recent revelations around the Fed and trades that were put on by various Fed presidents, which amounts to, I think, nothing short of a scandal, and how that impacts institutional trust, something that we've heard a lot about in the political sphere, but perhaps not enough about in the financial one, and to what degree that lack of trust in institutions, like the Fed, like regulators at the SEC, accounts for some of the behavior that we've seen in markets, what I've often referred to as financial or market nihilism. I also, to that point, want to talk about the growing inequality, again, often thought of as a political issue, but one that actually has a direct impact on asset prices, and to what degree this is also responsible for the type of behavior and speculative mania that we've seen in markets, particularly in meme stocks, but also in crypto. And of course, we have to talk about inflation. Is it transitory? Is it not transitory? To what degree are Fed officials even able to stem inflation? Should it get out of control, considering the state of private sector debt and the sensitivity to rising interest rates? I mean, what kind of leeway do Fed officials have? Those are just some of my questions, Robin, but I'm sure we'll find other ones as well. For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Robin, as well as the transcripts and rundowns to this episode and every other episode we've ever done, head over to hiddenforces.io and check out our episode library, or subscribe directly through our Patreon page at patreon.com/hiddenforces. There's also a link in the summary page to this episode with instructions on how to connect the Overtime feed to your phone so that you can listen to these extra discussions just like you listen to the regular podcast. Robin, stick around. We're going to move the next hour of our conversation into the subscriber overtime. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription, available through the Hidden Forces website or through our Patreon page at patreon.com/hiddenforces. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.